Welcome to another Jazz After Dark. You grab your drink, you come hang out with me, and I'll teach you something here. We're financial advisors here at Jazz Wealth, and I started doing these videos from home just to, I get a second wind at night, and I thought, well, maybe people will be interested in hanging out with me. And tonight, I am enjoying a beautiful old-fashioned with my cherry and orange, of course, orange wrapped around the rim there, and little orange bitters actually, and Horse Soldier is the bourbon of choice. Horse Soldier is a local brand here actually, or started here. They got a great location in St. Pete, and it's actually named after a special operations group out of Afghanistan that actually rode on horses when they first went into Afghanistan. So little history lesson there for you, but I want to basically go over briefly a wine and wealth class that I did for clients. Every Thursday we do a class called Wine and Wealth. It's just a laid back, kind of like this. It's just meant to be, strip away any of the sales pitch or anything like that, and strip away any of the general things you see me talk about, and really get down to details and use some data. A lot of times we do portfolio reviews or new product launches and things like that. And so I wanted to go over something here because I get this a lot. And I'm going to go over the data with you. You are told that the stock market averages 7% a year. You can't go wrong, right? And that's kind of true, because if you take out inflation, sure, it's about a 7% return. The raw returns are actually almost 10%, right? It's 9.9%. And when we say raw returns, that's just the performance. When we say the general average returns, at least as people talking about the S&P, well, they're talking about the inflation-adjusted returns. So first lesson of the night, there you go. Raw returns versus inflation-adjusted returns. Or you could even talk about internal rate of returns, which would include your dividends being reinvested, your dollar cost averaging, and things like that. So if you want to sound fancy, next time you're talking to your friends, there you go. Well, you're told 7%, and let's go with that. Inflation-adjusted returns of 7%. The problem is the stock market almost never returns 7% in a given year, right? And that's our fault as humans, because we have a calendar. The market doesn't care. It's moving, right? So our calendar, January through the end of December, I wondered, how often do we earn 7%? If we're trained to expect 7%, how often does that happen? First stat of the day for you. I want to go through the backside of this first. There's a 21% chance that the stock market will actually be down 10% or more in a given year, right? Not gain 7%. Right? So if we know that basically 1/5 of the time we're not going to see 7%, we've taken that out. Okay, what about the other 4/5? Well, that's got to be 7%, right? Not really. Let me share the data here with you, and actually this is a class that we did for clients, so I'm actually using this data, so it's not the most up-to-date data that we have. It's an older class. Here's a distribution of returns for the S&P that I plotted, and look how often the stock market gains between 5 and 10%. Only 6% of the time, 6.7% in its, what in the world? In its entire history, right? Look at that, from 1928 till basically just a couple years ago. In its entire history, that's done it 7% of the time. So a fun way to say it would be the stock market returns about 7% of the time, 7% of the time, right? In other words, you're expecting to see this, but you almost never see a return of 7%. So the first tip of the day is get that out of your head. If you're expecting 7% returns, even like every other year or just every so often, maybe we'll get 7. No, remember, it's an average return, right? So let's go back over here. 7% of the time. Where are the big gains and losses? What's the highest probability of something happening? I just shared with you a second ago, 21.3% of the time, you're going to lose over 10%. And 27% of the time, you're going to gain over 20%, right? How awesome is that? Well, on the 27% side, that's awesome, right? You're 1/4 of the time, you're going to see gains in a year of over 20%. We just went through a whole string of those years, actually. About 1/5 of the time, as we mentioned, you're going to lose more than 10%. So the rest of the time is kind of like whatever. What I want you to notice here real quick though, is the stock market doesn't like to be up or down just a little bit, right? 9% of the time we're 0 to 5%, 8% of the time between -5 and 0%, and of course the 7% of the time between 5 and 10%. The stock market likes to be up big or down big, right? So, and that's what this was saying here. I'm just remembering this class as we're talking, so I'm going through it, right? So we don't often see that. So what does that tell you? If the stock market starts off by having a rough year, we're either going to recover and go strong. Well, the odds are we're going to recover and go strong, or we're going to keep selling off a lot like this year. It's 2022 right now. So something you may want to consider there. And then I just itemized it for you so you could see every one of those years since looking back, right? We did this class in 2018. How often do you see a 7% return? How often do you see between a 5 and 10% return? How often do you see between a 0 and 10% loss? One time, right? One time. So 50.6% of the time, the returns are higher than average. That's good. So we know that basically every other year, this is not true, but on average, every other year, maybe we expect to see higher returns than the 7, well, in this case, the 10%. Okay, right? Get your mind wrapped around what the actual expectations are. And I should say that better. Get your mind wrapped around what the actual distribution of returns are over a lifetime. Now, if you're younger, you go, I don't care. This is, yeah, okay, great. Looks like it's going to be a good time. That's fine. But if you're older or in retirement and you're counting on making that small 5 to 10%, you're invested in the S&P, it's likely not going to happen more than twice through your retirement. That's it. Right? Here's the breakdown of those years, so you can see every year in a pretty poor green there, but you can see how often it was. It was more than 50% of the time, just looking back over that last 10-year stretch. Now, phase 2 of this conversation. You know this one, right? This is not new to you, that you know if you have a 5% loss, you can't have a 5% gain in order to break even, right? If you've seen this, Susie Orman was really big on this back in the day. She would talk about a 10% drop, and you can't have a 10% rally. You need an 11% rally. And she would, go on and on about that. Well, here's the breakdown of every percentage pullback, because this class was actually a class on how often the stock market falls more than double digits. So I was trying to share how often that happens. If you have a 20% drop like we had this year, 20 to 25%, and we stop that way, we would then need 25 to 33% in terms of a rally in order to get back to even. The markets tend to snap back rather quickly, and haven't you seen that a couple times this year? Did you see it during COVID? Right? We fell apart. It was all nasty, 36% down on the way there. We knew that we needed a 53 to 54% rally on the way back up, right? And so you can love the idea that here we're going to have these big declines, knowing that every single one of them in the history of the market has recovered and gone up. We know that. So we can now learn to love this as long as it's not going to take 10 years for me to recover from this 10% drop. Because I know if I'm down 10%, I need the full 10% back plus another 1%. As long as I can do that quickly, then I can handle a 10% drop. If it's a 20% drop, I need 25. As long as I can do that somewhat quickly, I'm happy to be an investor in the market. If I lose 20, I know I got to make back 25, but the odds of it show it's going to take 7 years. Well, there's a number of better, investing in classic cars is more advantageous than that, right? So that we know that the market has to recover quickly for us to stay interested, really. So here we go. I went through a bunch of examples and I showed the declines versus the gains. Just to put it in perspective, to share an example, in 1957, we lost 14.3%. 1958 was up 38. We can look here and say, well, that's about 15. Reference the chart. We're down 15. If we gain 18 in the next year or more, we broke even, and anything above that is gravy, right? Awesome. 1962, here's the exact performance, lost 11% on an almost straight vertical move lower there. The next year, we gained 18.9. Quick reference down here, that'll do, right? Here's some years where it doesn't work out, and this is not the most clean layout ever. 1973 and 74, you know, if you've been around, that was a horrible time period. And fun fact right here, what I call the Nixon nonsense, fun fact of the day. You ready? Every time I say Disney, that's a drinking word right there. But I'm going to give you a fact about Disney. Maybe you didn't know this. Excuse me. I hate to swallow in the mic. I know it's gross for some people. Remember Nixon's speech, "I am not a crook," right? I mean, even if you're not from that time period, you learned about it. You studied about it, right? Did you know that he gave that speech in a ballroom in the Contemporary Resort at Disney? Right outside of Magic Kingdom. That's where that was done. And so he was at the happiest place on earth when he was fighting for his life there. But fun fact, I don't know if you knew that. Anyways, okay, so 1973-74, chaos, horrible between the oil crisis and Nixon being a pretty public fraud and all that went down there. We lost 47%. Okay, cool. We need 80+% in order to get better. 1975 to 76 gained a total of 50.6%. I gave it away. That's not enough, right? It took 4 total years to recover. I can live with that. If we lost 47, that's a big number. So if it took 4 years to recover and then some, I might be all right with that. I don't know. That'd be a little odd right now, but that's okay. 1977 to 78, 79. That works out, right? We lost 11%. In 2 years' time, we gained back 13. Okay, I can live with that. 2000 to 2002 was one of the next nasty declines there, 46.5%. You see what you need down here. You know the number now. 2003 and 4 was not enough. It took 5.5 years for that to recover. And then, interestingly enough, we went through 2008 and it just started all over again. So that was pretty nasty there. The point is, and here it is actually, 2008, 38%, and 2009 and 10, 36%. Nope, that's not enough. It took 4.2 years to get back to break even. Now, if you had invested at the highs, right? So please keep that in mind. It could be a disconnect here. I'm saying if you were the worst investor ever and you invested at the tip top, in 2008, you'd have been down 38.5%. Okay, that's if you invested at the top, right? So that means it took 4.2 years for you not to fall, for you to come all the way back and then some. Most of you, I would say pretty much everybody watching this, there's not a chance that you invested $1 at the absolute top. It works both ways. If you're trying to buy the bottom of a market, you notice how you can never do that? You can't actually buy the top either. It's very difficult to do, although I might argue that it is pretty common there, right? Seems like it anyways. All right, so then what that boils down to, here you go. So a 10% decline or greater will take more than 2 years to recover. It should take more than 2 years to recover. We know now the magic number. We would need a full rally and then some to get there, right? That's where we're going. We're using this from the previous slide. But if you're thinking, what's the average recovery time? Now we fall 10%, 2 years. We're not used to that. We've been falling, here and there since COVID, right? We've had so much volatility. We've been falling a little bit more than that. So 2 years is the norm. We fell 36% during COVID and just whipped right back. That was an 11-day recession. Shortest recession on record ever. It was an 11-day recession in the market. And I should say that we saw, right? So in terms of that, having that bear market, eventually we found out was a recession. So that was horribly fast. It normally takes 2 years. So what do you learn from that? When markets pull back 10%, there's no hurry, right? If they fall more than 10%, that's the stats we're using. There's no hurry. Statistically, there's no rush to getting into the market. You dollar cost average into that sucker and soak up the lower basis while you can. You get what I'm saying there, right? If you're buying stock at 100, 102, 105, everything's going well, 110, and then you fall down to 90, 89, 85, 80, well, if you're buying at 85 and 80 and such, your average cost comes down. I think that's sort of, investing 101, but you get what I'm saying. You've got 2 years, right? So maybe a little bit shorter class here tonight, but I wanted to share with you some of the concepts that we talk about in our Wine and Wealth. Not all the time, right? But I like to put data together when it really makes a difference for you to see it and remember a number. Something stuck out to you tonight where you said, well, that's different there, right? And also, if you're curious, you can actually look at the archive and watch this class in its entirety in the dojo. And I just want to point out that we did this class while the markets were going up. I did that on purpose. I actually did a number of classes on recessions, bear markets, all the data, because my belief is if you're feeling good and the stock market's doing really well, that's the time to get something in your head. If the markets have already fallen and there's a hint of emotion in there, it's like your kids, right? When you take the candy away and they're crying, you're not really getting through to them. They hear what you're saying, but you're not making the same impact. So I like to do classes in reverse. Talk about the good times when things are bad and talk about the bad times when things are good. So you're ready. You have an open state of mind. You're willing to challenge, ask questions, debate things that maybe I've said, maybe incorrectly, or any data that might be wrong. So I enjoy that. Anyways, that brings us to the end here. I hope you've had a good time and you've been able to enjoy yourself here in Casa de Tebe. We'll try to keep doing these. I'm enjoying it. I'm having a good time. Let me know what you guys think down below if you're still with me and watching there. And I will wish you a great rest of your evening. Cheers.